Question 1. Annuities are often used to provide a steady stream of income during retirement. Which of the following factors most significantly impacts the payment amount for a fixed annuity? A. The payment frequency. B. The underlying investment options. C. The current interest rates guaranteed by the insurer. D. The length of the accumulation period. Answer: C. The current interest rates guaranteed by the insurer. Explanation: the payment amount for a fixed annuity is primarily determined by the guaranteed interest rate set by the insurer. Fixed annuities offer a fixed return on investment, and the insurer uses the current interest rates to calculate the future income stream. Unlike variable annuities, where the underlying investments can affect the payouts, fixed annuities do not depend on market performance, but rather the interest rate guarantee offered by the insurer at the time of purchase. The accumulation period and payment frequency also play a role, but they are secondary to the rate of return offered by the insurance company. Question 2. Scenario question. Mr. Smith is considering purchasing a deferred variable annuity to save for retirement. He is concerned about the risk of market fluctuations affecting his future retirement income. Which feature of a variable annuity would best mitigate his concerns? A. A guaranteed minimum withdrawal benefit. B. A death benefit rider. C. A fixed interest option. D. A rider for long-term care coverage. Answer: A. A guaranteed minimum withdrawal benefit. Explanation: a guaranteed minimum withdrawal benefit ride helps mitigate the risks associated with market fluctuations by ensuring that Mr. Smith will be able to withdraw a specified amount of income regardless of the performance of the underlying investments in his variable annuity. This provides a safety net, offering peace of mind even if the market performs poorly. The death benefit rider typically pays a death benefit to the beneficiary, but does not address withdrawal needs. The fixed interest option is not commonly available in variable annuities, and long-term care coverage would not address market risk concerns directly. Question 3. Which of the following statements is true regarding the taxation of annuities? A. Annuity premiums are taxed as income when paid. B. The accumulated value of an annuity grows tax-deferred until withdrawal. C. Annuity withdrawals are taxed as capital gains. D. Death benefits from an annuity are subject to estate taxes only. Answer: B. The accumulated value of an annuity grows tax-deferred until withdrawal. Explanation: the key tax advantage of an annuity is that the accumulated value grows tax-deferred until the funds are withdrawn. This allows the annuity holder to benefit from compound growth without paying taxes during the accumulation phase. When withdrawals are made, the earnings are taxed as ordinary income, not capital gains, which makes option C incorrect. Annuity premiums are generally paid with after-tax dollars, not taxed as income when paid, which rules out option A. While death benefits are typically not subject to income tax, they may be subject to estate taxes depending on the estate's value, which makes option D incomplete. Question 4. When a client chooses a fixed period payment option for their annuity, which of the following is a key characteristic of this option? A. The payments continue until the client's death. B. The payments are fixed and guaranteed for a specific time period. C. The payments increase based on inflation. D. The payments are flexible and can change annually. Answer: B. The payments are fixed and guaranteed for a specific time period. Explanation: a fixed period payment option guarantees payments for a specific number of years, regardless of whether the annuitant is alive. The amount of the payments is determined at the time of purchase and remains fixed throughout the payment period. Unlike life annuities, which last for the annuitant's lifetime, fixed period payments are limited to a set period, making option incorrect. Inflation adjustments or flexible payments are not typical characteristics of fixed period annuities, ruling out options C and D. Question 5. Scenario question. Mr. Green has a fixed annuity with a guaranteed interest rate of 3% for the first 5 years. After the initial period, the interest rate is adjusted based on the performance of an index. What type of annuity does Mr. Green have? A. A fixed annuity. B. A variable annuity. C. An indexed annuity. D. A hybrid annuity. Answer: C. An indexed annuity. Explanation: Mr. Green's annuity starts with a guaranteed fixed interest rate, but after 5 years, the interest rate is linked to the performance of an index. This is a classic feature of an indexed annuity, which offers the security of a fixed minimum rate with the potential for higher returns based on the performance of an external index, such as the S&P 500. Fixed annuities offer a guaranteed interest rate throughout the term, making option incorrect. Variable annuities, on the other hand, have returns based on the performance of the underlying investment options, not an index. A hybrid annuity is a more complex product and does not typically fit the description given in the scenario. Question 6. Which of the following is not a common rider for variable annuities? A. Guaranteed lifetime withdrawal benefit, B. Guaranteed minimum accumulation benefit, GMAB. C. Cash refund annuity. D. Mortality and expense, and E. Risk charge. Answer C. Cash refund annuity. Explanation. A cash refund annuity is a feature more commonly associated with certain types of life annuities, particularly life annuities with a refund option. This option provides a refund of the remaining balance of the annuity if the annuitant passes away before receiving the full value of the annuity. In contrast, guaranteed lifetime withdrawal benefit or guaranteed minimum accumulation benefits, GMAB, are common riders for variable annuities that provide guarantees on withdrawals or minimum accumulated values. Mortality and expense, risk charges are a characteristic of variable annuities to cover the cost of insurance-related risks. Question 7. Which of the following is a primary disadvantage of variable annuities compared to fixed annuities? A. They offer a guaranteed minimum return. B. They are subject to more market risk. C. They have a shorter accumulation phase. D. They are more expensive to administer. Answer B. They are subject to more market risk. Explanation. The main disadvantage of variable annuities is the exposure to market risk. Since variable annuities are linked to the performance of the underlying investment options, the value of the annuity can fluctuate based on the performance of those investments. Fixed annuities, on the other hand, provide guaranteed returns and are not subject to market fluctuations, which makes option B the correct answer. While variable annuities may have higher administrative costs, option D, the primary disadvantage is the market risk. A guaranteed minimum return, option A, is available through some riders, but the core feature of a variable annuity is its market exposure. Question 8. In North Carolina, which of the following is a requirement for an insurance agent selling annuities? A. They must only recommend annuities that have a 10-year payout period or longer. B. They must provide a suitability analysis based on the client's needs. C. They must only sell variable annuities. D. They must have a separate license for each type of annuity sold. Answer B. They must provide a suitability analysis based on the client's needs. Explanation. North Carolina, in line with NAIC, National Association of Insurance Commissioners, guidelines, requires that insurance agents provide a suitability analysis when recommending annuities. This ensures that the recommended annuity product matches the client's financial needs, goals, and risk tolerance. Agents must assess factors such as age, income, and objectives to recommend the appropriate product. The other options are incorrect because there is no specific requirement for annuities to have a 10-year payout, option A. Agents can sell both fixed and variable annuities, option C, and no separate license is required for each annuity product type, option D. Question 9. Which of the following tax treatments applies to non-qualified annuities when distributions are made? A. The entire distribution is tax-free. B. The principal is taxed as ordinary income. C. The earnings portion of the distribution is taxed as ordinary income. D. The entire distribution is taxed as capital gains. Answer C. The earnings portion of the distribution is taxed as ordinary income. Explanation. For non-qualified annuities, the principal is not taxed when it is withdrawn because it was already taxed when contributed. However, any earnings, interest, dividends, and capital gains are taxed as ordinary income at the time of withdrawal. This is the LIFO, last in, first out method of taxation, where earnings are considered withdrawn first and taxed at the ordinary income tax rate. Capital gains tax treatment, option D, does not apply to annuities as they are taxed as ordinary income, not capital gains. Question 10. Which of the following would most likely be considered an unsuitable recommendation for a client aged 75 with minimal savings and no long-term care needs? A. A deferred variable annuity with a 20-year accumulation period. B. A single premium immediate annuity with lifetime payments. C. A fixed annuity with a guaranteed interest rate. D. A fixed period annuity with a 5-year payout option. Answer A. A deferred variable annuity with a 20-year accumulation period. Explanation. A deferred variable annuity with a 20-year accumulation period is likely unsuitable for a 75-year-old client with minimal savings and no long-term care needs. Since the annuity would not start paying out for at least 20 years, this is too long a period for someone nearing retirement or already in retirement. Additionally, variable annuities expose the client to market risk, which may not be appropriate for someone with limited savings. A single premium immediate annuity, option B, would provide guaranteed income immediately, making it a more suitable option for a senior looking for reliable income. A fixed annuity, option C, or a fixed period annuity, option D, might also be better options depending on the client's specific needs. Question 11. Which of the following best describes a qualified annuity? A. An annuity purchased with after-tax dollars. B. An annuity that is part of a tax-deferred retirement plan. C. An annuity that is subject to capital gains tax. D. An annuity that provides a tax-free payout. Answer. B. An annuity that is part of a tax-deferred retirement plan. Explanation. A qualified annuity refers to an annuity purchased through a retirement plan like an IRA, 401k or 403b, where contributions are made with pre-tax dollars. These annuities grow tax-deferred until withdrawals are made. In contrast, non-qualified annuities are purchased with after-tax dollars, and only the earnings portion of the payout is taxable. Qualified annuities are not subject to capital gains tax, option C, and do not provide tax-free payouts, option D. Question 12. Scenario question. Mr. Robinson has purchased an annuity that offers a guaranteed minimum withdrawal amount each year, regardless of how the market performs. Which of the following annuity riders is most likely attached to his contract? A. Guaranteed minimum withdrawal benefit. B. Guaranteed minimum income benefit, GMIB. C. Guaranteed lifetime withdrawal benefit. Accumulation benefit rider. Answer. A. Guaranteed minimum withdrawal benefit. Explanation. The guaranteed minimum withdrawal benefit ride ensures that the annuitant can withdraw a minimum amount each year, regardless of market conditions. This is the most appropriate rider for Mr. Robinson as it guarantees a certain level of withdrawals. The guaranteed lifetime withdrawal benefit although provides lifetime withdrawals, but it typically focuses on providing income for life, not just withdrawals during a specified period. GMIB provides a guaranteed income stream, while an accumulation benefit rider focuses on growing the annuity's value, which does not match the scenario. Question 13. Which of the following is true about fixed annuities? A. They offer returns based on the stock market's performance. B. They provide a fixed, guaranteed income for a specified period. C. They are subject to the same market risks as variable annuities. D. They are suitable for individuals who want to invest in equities. Answer. B. They provide a fixed, guaranteed income for a specified period. Explanation. Fixed annuities offer a guaranteed interest rate for a specific period, providing predictable and stable income. They do not have exposure to the stock market, unlike variable annuities, option C, and they do not offer returns based on market performance, option A. Fixed annuities are not suitable for individuals seeking to invest in equities, option D, as they focus on safety and guaranteed returns. Question 14. When an annuitant elects to take their annuity in a lump sum, what is the tax treatment? A. The entire lump sum is tax-free. B. The earnings portion of the lump sum is taxed as capital gains. C. The entire lump sum is taxed as ordinary income. D. Only the principal portion of the lump sum is taxable. Answer. C. The entire lump sum is taxed as ordinary income. Explanation. When an annuitant takes a lump sum distribution from an annuity, the entire amount, except for the principal portion, which was already taxed, is subject to taxation as ordinary income. Annuity earnings are taxed as ordinary income when withdrawn, not as capital gains. Therefore, option C is correct. Question 15. Scenario question. MS. Clark purchased an annuity that will pay her fixed income for the rest of her life, regardless of how long she lives. What type of annuity did she likely purchase? A. A life annuity with a cash refund option. B. A fixed period annuity. C. A variable annuity. D. A life annuity. Answer. D. A life annuity. Explanation. A life annuity provides income for the rest of the annuitant's life, regardless of how long they live, which is what MS. Clark purchased. A life annuity with a cash refund option, option A, provides the same lifetime payments, but if the annuitant dies before receiving the full amount paid for the annuity, the beneficiary receives the remaining balance. A fixed period annuity, option B, provides payments for a fixed number of years, not for life. A variable annuity, option C, has returns tied to investments, unlike a fixed income provided by a life annuity. Question 16. Which of the following riders can provide a guaranteed death benefit in the event of an annuitant's death? A. Guaranteed minimum income benefit GMIB. B. Death benefit rider. C. Guaranteed minimum withdrawal benefit W. Accumulation benefit rider. Answer B. Death benefit rider. Explanation. The death benefit rider ensures that if the annuitant dies before annuitization, the beneficiary will receive at least the amount of the premium paid or another guaranteed amount. The GMIB rider, option A, guarantees a minimum income, not a death benefit. The GMWB rider, option C, guarantees withdrawals but not a death benefit. The accumulation benefit rider, option D, focuses on growing the value of the annuity, not providing a death benefit. Question 17. Which of the following describes an immediate annuity? A. An annuity that starts paying out income immediately after purchase. B. An annuity that provides income after a set number of years. C. An annuity that allows for investment in equities. D. An annuity that offers flexible payments that change based on market performance. Answer A. An annuity that starts paying out income immediately after purchase. Explanation. An immediate annuity begins paying out income right after purchase, typically within 1 month. In contrast, a deferred annuity, option B, starts payments at a future date. An annuity that allows for investment in equities is a variable annuity, option C, and one that offers flexible payments based on market performance is also a variable annuity, option D. Question 18. Which of the following is a disadvantage of variable annuities? A. They offer a fixed income stream. B. They are not subject to market fluctuations. C. They have higher fees compared to fixed annuities. D. They provide a guaranteed return. Answer C. They have higher fees compared to fixed annuities. Explanation. Variable annuities often come with higher fees compared to fixed annuities because they include charges for investment management, mortality, and administrative costs that do not provide a fixed income stream, option A, as the payouts are based on the performance of the underlying investments. Variable annuities are subject to market fluctuations, option B, and while some offer guarantees, the return is not guaranteed, option D. Question 19. Which of the following would likely be a key reason someone would choose a deferred annuity? A. They want immediate income from the annuity. B. They need to defer taxes on their earnings. C. They want to guarantee their death benefit. D. They need liquidity for immediate expenses. Answer B. They need to defer taxes on their earnings. Explanation. Deferred annuities allow individuals to defer paying taxes on the earnings portion of their investment until they start receiving payouts, making it an attractive option for tax-deferred growth. If someone needs immediate income, they would likely choose an immediate annuity, option A. The death benefit, option C, is a feature of some annuities, but it is not the primary reason for choosing a deferred annuity. Deferred annuities are also less liquid, option D, than other financial products, as funds are tied up until payouts begin. Question 20. Scenario question. Mr. and Mrs. Williams purchase an annuity with the option to have payments continue for as long as either of them is alive. What type of annuity did they purchase? A. A joint and survivor annuity. B. A single life annuity. C. A fixed period annuity. D. A variable annuity. Answer A. A joint and survivor annuity. Explanation. A joint and survivor annuity provides income for the lives of both annuitants, in this case Mr. and Mrs. Williams, and continues for the survivor after one of them passes away. This option ensures ongoing payments regardless of how long either person lives. A single life annuity, option B, only covers one person. A fixed period annuity, option C, pays for a set period. And a variable annuity, option D, links payments to investment performance, not the lives of the annuitants. Question 21. Which of the following statements about annuities is correct? A. Annuities are always tax-free. B. Annuities provide a guaranteed return on investment. C. Annuities are suitable for individuals seeking short-term investments. D. Annuities can offer tax-deferred growth. Answer D. Annuities can offer tax-deferred growth. Explanation. Annuities are designed to allow the earnings on the investment to grow tax-deferred until withdrawals begin. This means that individuals don't pay taxes on the interest or gains until they take the money out. They are not tax-free, option A, and don't guarantee returns, option B, as returns can vary. Annuities are typically long-term products, not suited for short-term investments, option C. Question 22. Which type of annuity provides income that varies based on the performance of underlying investments? A. Fixed annuity. B. Variable annuity, C. Immediate annuity, D. Deferred annuity. Answer B. Variable annuity. Explanation: variable annuities have payouts that are based on the performance of the underlying investments chosen by the policyholder, such as stocks or bonds. Fixed annuities, option A, provide a guaranteed fixed income. Immediate annuities, option C, start payouts right after purchase, but the income is not linked to investments. Deferred annuities, option D, only delay the start of payouts and can be either fixed or variable. Question 23. Which of the following is an example of an annuity payout option? A. Fixed annuity. B. Lump sum distribution. C. Life with period certain. D. Term insurance. Answer: C. Life with period certain. Explanation: the life with period certain option ensures that the annuitant will receive payments for the rest of their life, but also guarantees payments for a specified period, e.g. 10 years. If the annuitant dies during that period, the beneficiary continues to receive payments. A fixed annuity, option A, is a type of annuity but not a payout option. A lump sum distribution, option B, refers to a one-time payout, not an annuity option. Term insurance, option D, is a life insurance product, not an annuity. Question 24. Scenario question: Mr. Daniels is considering purchasing an annuity that will provide him with regular income for a certain period of time, such as 20 years. Which annuity option would be best for him? A life annuity. B. A fixed period annuity. C. A joint and survivor annuity. D. A variable annuity. Answer: B. A fixed period annuity. Explanation: a fixed period annuity provides income for a specified period of time, such as 20 years, regardless of the annuitant's lifespan. This makes it the best option for Mr. Daniels. A life annuity, option A, would provide income for his lifetime. A joint and survivor annuity, option C, would provide lifetime income for two individuals, and a variable annuity, option D, ties payouts to investment performance. Question 25. Which of the following best describes an annuitant's annuity certain option? A. Payments are made for a fixed time period regardless of the annuitant's death. B. Payments continue for the annuitant's lifetime. C. Payments are guaranteed only if the annuitant lives for a specific number of years. D. Payments depend on the performance of the underlying investments. Answer A. Payments are made for a fixed time period regardless of the annuitant's death. Explanation: an annuity certain guarantees payments for a set period regardless of whether the annuitant lives or dies during that time. If the annuitant dies before the period ends, the remaining payments go to the beneficiary. Option B describes a life annuity, option C refers to a guaranteed period annuity, and option D refers to variable annuities. Question 26. Which of the following is a benefit of purchasing an annuity? A. Guaranteed principal protection. B. Immediate liquidity of funds. C. Flexibility to change payment amounts at any time. D. Regular income payments that can last for life. Answer: D. Regular income payments that can last for life. Explanation: one of the key benefits of annuities is that they can provide regular income for the annuitant's lifetime. This guarantees financial stability and peace of mind. Annuities generally do not offer immediate liquidity, option B, as funds are typically locked in until payouts begin, while some annuities offer some flexibility in payment options, option C, they are primarily designed for stable long-term income. Principal protection, option A, is not guaranteed unless specifically stated in the contract. Question 27. Which of the following annuities offers the greatest potential for growth? A. Fixed annuity. B. Immediate annuity. C. Variable annuity. D. Deferred annuity. Answer: C. Variable annuity. Explanation: a variable annuity offers the greatest potential for growth because its returns are tied to the performance of underlying investments such as stocks or bonds. Fixed annuities, option A, offer guaranteed but often lower returns. Immediate annuities, option B, start paying income immediately, but they do not have growth potential. Deferred annuities, option D, can be either fixed or variable. The growth potential depends on whether the annuity is fixed or variable. Question 28. What is the surrender charge associated with annuities? A. A fee for taking a lump sum distribution. B. A fee for withdrawing funds before a certain period. C. A fee for changing annuity providers. D. A fee for transferring investments within a variable annuity. Answer: B. A fee for withdrawing funds before a certain period. Explanation: a surrender charge is a penalty fee that annuity holders may incur if they withdraw funds from their annuity before the end of the surrender period, typically within the first 5 years. This period is designed to encourage long-term investment. A lump sum distribution, option A, may trigger taxes, but not typically a surrender charge. Changing providers, option C, or transferring investments, option D, generally does not involve surrender charges. Question 29. Scenario question. Mr. Robinson purchased an annuity that guarantees a minimum income level, but also allows for higher payouts if the market performs well. What type of annuity is this? A. Fixed annuity. B. Variable annuity. C. Equity indexed annuity. D. Immediate annuity. Answer: C. Equity indexed annuity. Explanation: an equity indexed annuity offers a guaranteed minimum income level but allows for higher payouts based on the performance of an equity index such as the S&P 500. This type of annuity blends the security of a fixed annuity with the potential for market-based growth. Fixed annuities, option A, provide a set guaranteed return. Variable annuities, option B, are linked to market performance but do not guarantee a minimum return. Immediate annuities, option D, begin payouts right away and do not have market performance features. Question 30. Which of the following factors can influence the payout amount of a variable annuity? A. The annuitant's age. B. The underlying investment performance. C. The length of the annuity contract. D. The fixed interest rate. Answer: B. The underlying investment performance. Explanation: the payout amount of a variable annuity is influenced by the performance of the underlying investments, such as mutual funds or stocks. If the investments perform well, the payout can increase, but if they perform poorly, the payout can decrease. The annuitant's age, option A, and the length of the contract, option C, affect life expectancy assumptions and income duration, but not the variable annuity's actual payout amount. A fixed interest rate, option D, applies only to fixed annuities.